Only a few days left. Do you realize that a massive flood of money is about to pour into the U, market larger than any wealth transfer event in modern history? $4.7 trillion is set to flow straight into the American economy, not through bailouts, not through crisis, but as a real torrent of cash. Most individual investors are still distracted by what they see on their screens, while Wall Street and big institutions have quietly accumulated positions and positioned themselves long ago. If you miss this moment, you won't just stand on the sidelines. You will watch others multiply their wealth many times over while you are quietly left behind. This is not empty promise or political hype. This is reality that market history has repeated many times. When enormous capital flows are triggered by policy, it creates explosive growth for those who are ready and wipes out value for portfolios positioned incorrectly. Trump's tax and stimulus plan is not just tax cuts on paper. It is the most powerful market catalyst seen in decades, strong enough to create waves of new millionaires while forcing those who ignore it to pay a heavy price. I will guide you through the exact timeline, the 5 main waves of capital that will hit, and the 6 sectors expected to absorb the largest share of this money first. Opportunity does not wait. It arrives fast and disappears even faster. Stay until the end, because I will share the precise dates and positioning strategies that years of experience in banking law and policy cycle analysis have helped me identify. This has nothing to do with whether you support or oppose Trump. I care about only one thing: when $4.7 trillion actually flows into the system, what happens next? Because history has never been wrong about this. If you are not prepared, you will not participate in that flow. You can only stand on the edge and watch other people's assets surge. Let us go a little deeper. What most people overlook is the timed nature of these policies. The major tax cut bill of 2025 and the Jobs Act 2.0 are not simply about lowering rates. They are designed to create clear staged ripple effects. The bill is expected to pass in March 2025, but the real economic impact will unfold in 3 major waves. The first wave, from late February through the second quarter of 2026, is an unusually early tax refund season. Millions of households will receive significant cash directly in hand. The second wave, from July to September, focuses on corporate capital repatriation. Enormous sums that companies have held overseas will return home, creating an unprecedented source of domestic investment power. The third wave, running through the fourth quarter, will be the surge of accelerated depreciation and massive business capital spending. According to estimates from the Congressional Budget Office and the Treasury Department, about $2 trillion will flow to individuals through tax refunds averaging roughly $8,500 per household. Corporations are projected to bring back $2.1 trillion in cash from abroad, while an additional $1.4 trillion will be unleashed through faster depreciation and business investment. In total, within just 9 short months, $4.7 trillion will flood into the U economy, a figure 3 times larger than the bank bailout package of 2008, and massive enough to profoundly reshape the market landscape. Compared to the most recent economic stimulus package, this figure is more than twice as large. In other words, nearly 1/5 of the entire U economy will be injected directly into the system in less than 12 months. We have seen similar money injections before, but never at this scale or speed. Let us look back at 2017, when the tax cuts took effect. With just $1.5 trillion, the S&P 500 index rose almost 30% in the 18 months that followed. During the Bush-era tax cuts, small-cap stocks surged 47%, while REITs climbed 38%. And under Reagan, in the early 1980s, the Dow Jones more than doubled, rising 135% over the next 5 years. But what makes 2026 completely different is the starting foundation. Unemployment is at a historic low record. The Federal Reserve is cutting interest rates steadily. Consumer demand has been pent up for years, ready to explode. This is not a typical recovery cycle. This is rocket fuel being poured into an engine that is already running at full throttle. And here is the most common mistake investors make. They react instead of anticipating ahead. By the time the media starts shouting about the tax refund, boom, most of the easy money has already been taken. Big institutions and smart money have acted early, right now, before the cash even hits people's bank accounts. Knowing a major event is coming is only the first step. Knowing what to do with it is what matters most. That is why I always stress the importance of thinking long-term, looking beyond the crowd, just as the top investors have done for decades. They do not wait for clear market signals. They position themselves before those signals become headlines. Now let us return to the actual flow of this $4.7 trillion. It does not pour in all at once. It moves through 5 distinct waves, each bringing its own unique opportunities. Missing even one wave means you leave significant rewards on the table. We are currently in the very first phase, wave 1. The bill is passed, but the money has not yet been dispersed. This is exactly when institutional investors rush in to buy positioning ahead of the tax refund season. You start to see defensive sectors weaken quietly. Utilities and consumer staples slow down, while growth stocks and small caps begin to outperform silently. Volatility drops. The VIX index slides lower. Uncertainty fades. Clear signs that smart money is moving. History shows that in this early phase, capital tends to flow first into small cap stocks, discretionary consumer goods, and home building companies. At the end of 2016, just before the previous tax cuts, small caps rose 15% in only 3 months, while large caps gained just 6%. The Russell 2000 outperformed the S&P 500 by 9 percentage points in a single quarter. That exact scenario is repeating now with even greater intensity. The second wave is when things truly explode. That is the massive wave of tax refunds hitting consumers' hands. And as we have seen, that will arrive earlier than ever, possibly as soon as late February, the earliest in history. About $1.2 trillion will flood directly into bank accounts. At that point, consumer behavior becomes the key driver. Americans rarely save all of this unexpected windfall. They spend it with an average of around $8,400 per household. The ripple effect will be powerful. Historical data from the IRS and Treasury Department shows the typical breakdown. Clearly, about 35% goes straight to paying down debt. Credit cards, car loans, personal loans. Americans tend to be far more responsible than people think when real money lands in their accounts. The next 25% flows into discretionary spending. Vacations, travel home, repairs, electronics, appliances, all the things postponed during tight times. Around 20% goes to savings and investments, brokerage accounts, retirement funds, sometimes a small portion into crypto or gold. The remaining 20% covers essentials: rent, utilities, food insurance. The result, retail stocks will benefit the most. Think Amazon, Walmart, Target, Home Depot, Best Buy. Travel and leisure sectors will surge in a similar way. As consumer spending accelerates, this is precisely when the market enters its strongest growth phase. As consumer spending accelerates so powerfully, the benefiting sectors will spread out quickly. Airlines, hotel chains, cruise companies, online booking platforms all stand ready to capture this explosive wave of spending behavior. When people suddenly feel wealthier, they rarely sit at home staring at their bank balance. They take action, booking flights, reserving hotels, planning getaways, things postponed for far too long. Brokerage platforms will also see a clear inflow of capital. Robinhood, Fidelity, Charles Schwab. Trading activity surges as cash becomes more abundant and investor confidence rises. Even credit card companies like Visa, MasterCard, American Express continue to perform strongly despite any regulatory noise or political pressure. When spending rises, transaction volume rises with it. A simple but extremely powerful relationship. After the initial spending phase, a positive feedback loop begins to form. Corporate revenues climb, higher profits improve valuation, multiples expand, and money flows back into the market even faster. That is the self-reinforcing mechanism, a virtuous cycle that stock markets love. Look back at the 2008 stimulus checks under Bush for clear proof. Retail sales jumped 12% in just the month the money was distributed. This time the scale is 7 times larger, an enormous figure far beyond any previous comparison. Of course, long-term public debt is a real issue worth watching, but right now we are focused on identifying the cycle and making the smartest use of it. Now let us move to the third wave, corporate capital repatriation. So this is not about bringing bodies home. It is about bringing cash home. The tax bill includes a one-time repatriation holiday allowing UP corporations to bring massive overseas cash back at a reduced tax rate. Right now that amount is estimated at around $2 trillion, a colossal pool of capital waiting to be unleashed. Why did companies park money overseas in the first place? mainly taxes. Apple, Microsoft, Google, Netflix, they have accumulated hundreds of billions in tax-friendly jurisdictions like Ireland, the Netherlands, and a few other places. No disrespect to the Irish, they are wonderful people. But corporations did not choose those locations just for cultural reasons or world records. Who benefits most from this repatriation wave? First, the large cap technology giants. Apple, Microsoft, Alphabet, Meta. This group alone holds more than $500 billion overseas. Next, major pharmaceutical companies, Pfizer, Johnson, and Johnson Merck. Heavy industrial names, General Electric, Honeywell, United Technologies, familiar pillars of the real economy. The most important question for investors: what do companies actually do with repatriated cash? History gives a very clear and consistent answer. About 40% typically goes to stock buybacks, reducing shares outstanding, which mathematically drives up the price of remaining shares. Another 30% flows into dividends, something institutional investors, retirees, and income-focused funds always welcome. Around 20% is used for mergers and acquisitions, activity that can spark debate about long-term value but delivers big fees to investment banks arranging the deals. The remaining 10% goes to genuine business investment. The outcome is straightforward. Large cap technology stocks shine brightly. Stable dividend-paying companies like Johnson & Johnson, Coca-Cola, Procter & Gamble often outperform strongly in this phase. Increased M&A activity boosts profits for investment banks and advisory firms. The last major repatriation holiday was in 2004, when $312 billion came home. The S&P 500 rose 15% that year, and technology stocks gained 22%. This time, the repatriated amount is 7 times larger. The logical outcome scales accordingly. Now on to the fourth wave. Not an attack, but a powerful capital injection through accelerated depreciation. The tax bill allows companies to deduct 100% of capital investments immediately instead of spreading it over many years. This creates enormous incentive to spend capital right now rather than delay. Who benefits? Heavy equipment manufacturers like Caterpillar, Deere, 3M, construction and engineering firms, Fluor Jacobs Engineering, infrastructure and systems companies, Cisco, Oracle, Salesforce, and the energy and utilities sector, grid modernization, solar power, wind, energy transmission, line upgrades, all get a strong push from this attractive depreciation policy. This depreciation wave alone represents about $1.4 trillion in capital spending, a massive amount capable of reshaping entire industries. A large portion of that money will flow into process automation, artificial intelligence, development, modern energy infrastructure, and especially reshoring supply chains back to American soil. A trend that is becoming increasingly clear. Deliberate. When viewed through thematic lenses, heavy industry and basic material sectors typically stand out the most in cycles like this. History proves it. Industrial ETFs like XLI or stocks in the manufacturing group often outperform strongly when capital expenditure accelerates. Key materials such as steel, copper, and aluminum always benefit powerfully when infrastructure and construction demand surges. This is not speculation, it is an economic pattern that is repeated many times. For a specific example, recall 2017. Business investment rose only 6%, yet industrial stocks jumped 34% in that same year. Impressive returns achieved without excessive risk. So, in the current phase, what deserves the most attention? Companies with large order backlogs, especially those tied to strategic commodities like copper, the metal now vital to energy transition and high-tech applications. But with the labor market still experiencing persistent shortages, an unavoidable side effect will emerge. Inflationary pressure. And inflation, though often seen as an enemy, creates opportunities for certain asset classes. Gold, silver, and other tangible commodities tend to shine in such environments. The harsh reality is that injecting $4.7 trillion into the economy cannot happen without consequences. It generates abundant liquidity that drives asset prices sharply higher. We saw the same dynamic during the pandemic when the Federal Reserve printed trillions. Understanding where that liquidity flows and when, that is the difference between riding the wave successfully and being swept away by it. Even so, the Federal Reserve will respond, and this is where the picture becomes far more complex. In a normal economic setting with a truly independent Fed led by economists confident in their models, rising inflation would trigger interest rate hikes. That is the classic mechanism. But 2026 is not a normal environment. We are seeing a continued trend of rate cuts. Why? Because there is strong political pressure for lower rates, and appointees will reflect that preference. After the midterm elections, if inflation accelerates back toward 3% or higher, tightening policy will once again come under consideration. That is the largest risk window. And there are clearly systematic efforts to prevent it from happening, you may have already noticed, through policies aimed at lowering oil prices, capping credit card rates below 10%, and pushing down housing costs. The goal is straightforward. Make everyday inflation virtually invisible to ordinary people. Cheaper gasoline, stable food prices, credit card bills that stop climbing, people keep spending freely and believe the economy is still running smoothly. But here is the part most people completely overlook. The true measure of inflation is not grocery or fuel prices, it is asset prices. When the stock market rises 25%, that is 25% inflation for those who own stocks. Your wages do not rise accordingly, but the wealth of asset owners surges. They become significantly richer in real terms. Conversely, if you hold no assets, the purchasing power of your cash erodes day by day. That is an unavoidable truth in the modern monetary system. The only logical conclusion is clear. Invest as much as possible into real assets, stocks, real estate, gold, silver, commodities, because that is precisely how this system preserves and grows value. Timing, however, remains the critical factor. This liquidity wave will continue pushing markets higher throughout 2026. But if inflation truly reignites, as it did in 2021 and 2022, rate hikes will return in 2027. When that happens, market leadership will shift dramatically. Remember that period. Energy stocks rose 65%, while technology stocks fell as much as 35%. Many have already forgotten that lesson. Therefore, the truly intelligent strategy goes beyond simply capturing the upswing. It lies in knowing exactly when to take profits from richly valued growth stocks and rotate into sectors that thrive under tighter economic conditions. That is genuine risk management and the way to protect gains across multiple cycles. Now let us dive into the specifics. Where exactly will this massive flow of money go, and which sectors will stand out most in each phase? For the second wave, the huge surge of tax refunds flooding into consumer hands. The clearest winners are the major consumer-facing giants. Amazon with its e-commerce dominance, Home Depot with home improvement and construction demand. These names will directly capture the explosive spending wave. If you prefer a broader approach rather than picking individual stocks, consumer-focused ETFs will be a sensible way to capture the overall trend. Technology continues to be one of the biggest benefiting areas, not only from household spending, but also from corporate capital flows. Apple holds enormous potential for massive share buybacks once repatriated cash returns home, effectively boosting shareholder value. Microsoft benefits doubly from enterprise spending and the explosive growth of cloud computing, the core foundation for every digital transformation. The QQQ fund captures this entire large cap technology group in a balanced way. I remain strongly optimistic about NVIDIA due to unrelenting demand for AI chips, and about Alphabet thanks to recovering advertising revenue and a robust consumer cycle, plus accelerating monetization from artificial intelligence. These companies are truly printing profits at an impressive pace. The financial sector will also receive a significant boost. Mergers and acquisitions, activity surges, investment banking becomes highly active, capital markets turn vibrant again, all creating a favorable environment. JP Morgan, as the global leader, stands to gain enormously from transaction flows and service fees. Goldman Sachs typically shines when capital markets regain momentum. Even amid political pressure, Visa continues to grow solidly, purely on higher transaction volumes, clear proof of the strength in its business model. Brokerage platforms like Schwab and Robinhood will see retail trading explode as liquidity becomes abundant. For broad exposure to finance, the XLF fund offers comprehensive coverage. While not as powerful as technology or consumer sectors, finance remains an essential part of this cycle. As we move deeper into the later part of the year, energy will gradually take center stage. If geopolitical situations in Venezuela or other oil-producing regions become clearer, major players like Exxon, Chevron, ConocoPhillips will benefit directly from expectations of stable or rising oil prices. This is a positioning decision suited for the end of 2026. Traditional energy giants do not change overnight, but when inflationary pressures return, their defensive and growth roles become more critical than ever. At the same time, next-generation energy companies and those focused on energy infrastructure, especially grid modernization, will also attract strong capital inflows as depreciation policies continue to drive investment. Once again, timing is decisive. We need clarity before committing full resources. Then we come to the sixth sector, real estate. Why does it perform so effectively? Because tax refunds act like a massive down payment combined with gradually falling interest rates and long pent-up housing demand. The result is strong performance in industrial land and warehouse rents. Home ownership becomes far more attractive as borrowing costs decline. Names like Equity Residential and Simon Property Group are classic examples worth watching. For broader exposure, the VNQ fund provides diversified access to the entire real estate sector. This is not personal financial advice, only educational observation of the cycle. But understand clearly, this $4.7 trillion flow does not happen quietly. It reshapes the entire market. And the difference between winners and losers comes down to one single factor: preparation ahead of time. There is another often overlooked beneficiary when rates fall. Student loans will undergo major restructuring, and SoFi leads the nation as the #1 platform for student loan refinancing. Lower interest rates mean a sharp surge in refinancing volume, a direct and powerful driver for the company. So how will the real progression unfold? If you want to lead this cycle, look toward the highest risk, but also highest potential reward areas in the early phase. Small cap stocks, funds like IWM or VB provide broad exposure to that group. You can also be more optimistic about discretionary consumer spending. The XLY fund is a popular and effective choice. Reducing bond allocation at this stage is almost self-evident in theory as abundant liquidity pushes equity prices higher. Retail remains a sector to watch closely. The XRT fund offers diversified access to major retailers. Travel and leisure will also explode. Airlines, hotel chains, cruise companies, all poised to capture the long-suppressed wave of vacation spending. As liquidity spreads abundantly throughout the system, people's behavior will change noticeably. In the middle of the year, discretionary consumer spending remains steady, even as inflation data is watched closely month by month. But at a certain point, the inflation numbers in the headlines gradually lose their weight. Real liquidity becomes the far more dominant force than any sensational title. Throughout the summer, the wave of corporate capital repatriation truly begins to shine brightest. That is, when large cap technology companies and stable dividend payers stand out most prominently. The QQQ fund remains a simple and effective way to capture that entire group without overly complicated selection. Dividend-focused ETFs like VYM or SCHD also tend to perform very well in this phase because repatriated cash prioritizes dividends and share buybacks, actions that directly enhance shareholder value. Then as we enter the third quarter, the capital expenditure explosion really takes off. All the money the companies can immediately depreciate starts pouring into production equipment, infrastructure, process automation, artificial intelligence, renewable energy, and reshoring supply chains. Heavy industry and basic materials will draw major attention. The XLI fund, representing that group, often accelerates strongly. Steel, aluminum, copper, these strategic metals all benefit directly from surging infrastructure and manufacturing demand. I continue to hold a firmly optimistic view on gold and silver. The market may fluctuate, especially silver with its higher liquidity, but the overall trend toward year-end remains one of significant appreciation. That is also when we need to monitor inflation closely once again. The most effective inflation hedges remain gold, oil, Bitcoin, and energy stocks, assets capable of preserving and growing value as price pressures spread. And this is a reasonable phase to start considering taking partial profits from the highest valued growth and technology stocks to avoid seeing paper gains eroded as the cycle shifts. That is how I see the full progression of this year. And yes, much of it ultimately revolves around one central figure on the policy chessboard. You already know who I am referring to. Could anything derail the entire scenario? Of course it could. The Fed chair might decide to act independently in their own way. We have seen that happen before. Even when appointed under Trump and holding clear Republican views, some have been willing to print trillions as an inevitable part of the system. Once it starts, it is very hard to stop. Consumers might unexpectedly change behavior. They could worry about the future, fear artificial intelligence taking jobs, and choose to save rather than spend. That is entirely possible. But even if saving rises, the money does not stop flowing. It simply redirects. Retail may cool slightly, but those savings will flow into brokerage accounts. Robinhood, Schwab, Fidelity all benefit from a surge in individual investing. And when American consumers invest, they usually choose the most familiar names. Microsoft, Amazon, Apple, Tesla, SoFi, Robinhood. That is simply human nature, always leaning toward what they know and trust. Some will argue that all of this is already fully priced in. I do not fully agree. When I talk to people outside the Wall Street expert circle, they are genuinely shocked to learn the scale and timing of this flow. So if you are following these analyses, you are already ahead of most of the crowd. And if you believe others should also understand this important information, share it so they have a chance to prepare. That truly makes a difference. But seriously, if you want to approach 2026 systematically rather than relying on guesswork, that is exactly why I maintain my private group. I share exclusive weekly analysis videos showing precisely which stocks I am buying, how I position portfolios and strategies to spot opportunities early and invest like top-tier investors. Details are in the pinned comment below. And before we wrap up, I want to leave you with one final thought. Gold and silver are currently at all-time highs or very close to them, and your instinct might tell you the opportunity is past. But the reality is quite the opposite. Central banks are buying gold at a pace not seen since 1967. That shows the long-term flow remains very powerful. I wish you a strong, prosperous 2026 filled with wise decisions. All the very best.